basically you have no roadmap. So the only way one should buy stocks is if you understand the underlying business. You stay within circle of competence, you buy businesses you understand, and if you understand the business, you understand what they're worth. And that's the only reason you ought to buy a stock.
Well, I would say good traits or important traits for being a good investor. Number one, the single most important skill is patience. So I think the thing is that markets have kind of a way of deceiving us, because when you turn on CNBC and you see all those flashing red and green lights and all that, it's inducing the brain to think that you need to act now and you need to act immediately, where nothing could be further from the truth. Buffett always talks about having this punch card where in a lifetime you make 20 punches, and each time you buy a stock you punch it once. So in a lifetime you'd make 20 investment decisions, which means that if you started investing at 20 and ended at 80, every 3 years on average you'd make one investment. And that is very hard for most people to do. And so the more you can slow down your investing and the more patient you can be. So the issue is that the time scales over which companies go through change and such is very different from the time scales at which stock markets operate. And so you really have to not focus so much on the stock market and have a lot more focus on the nature of change in businesses and be willing to be in there for a while. And like I told you, for the compounding to work, you don't need to double your money every 3 months. Even if you double your money every 3 years or even every 5 years, that's plenty, because it's just a matter of how many doubles you can get and such. So patience is the number one skill set. The second, I think, important skill would be that if you have run a business before, it's a huge advantage because of the whole interplay between investing and running a business, because it's very important to be able to understand how a CEO thinks and the factors that they are primarily focused on thinking about when they're running the business. And that's hard to get to with spreadsheets and so on. And I think another very important trait for successful investing is to stay within your circle of competence. So I think Buffett always says that it's not the size of the circle that matters, but knowing its boundaries. It's absolutely critical. And Charlie Munger talks about that. He gives a couple of examples. One is he says that if in a small town you bought the McDonald's franchise, you bought the Ford dealership. Ford dealership, gas station not so good. And gas station we leave for the Patels, low cost operations. Okay, and then you want the best Class A office building, and you want the best residential building, right? So if you got these 4 assets, and you don't need to own them completely, you could own 20% of each of them, right? So his perspective was that if in Peoria, Illinois, you own these 4 assets, and you just sat on them for your whole life, you would end up probably quite wealthy. And so if you think about it from a modern portfolio theory point of view, you would say, well, you're not diversified, everything's in one geography, et cetera, et cetera. Yeah, but the odds I'd probably still work out. And in fact, he has a friend here in near Stanford, John Arriaga, who all he did was bought real estate within a mile of the Stanford campus. And I think Arriaga is a billionaire. And so what is Arriaga's circle of competence? It's this small. So the size of the circle is not relevant. Staying inside the circle is very fundamental. So I think circle of competence is a very important trait. Another important trait is margin of safety. So you buy things for well less than what they're worth. And then I think the final piece would be that what Ben Graham says, that you're not buying a piece of paper, you're buying a fraction of a business. So if I were to think about investing in Google, for example, the question I should ask myself is, if my family had $1 trillion, would I be happy putting 410 billion? Is that what the market cap is right now? 410 billion, right? So if I had $1 trillion, would I be comfortable putting 410 billion into Google? And if the answer is no, then I shouldn't put $10 into Google, right? So the mindset, so many times when people say, what do you think of Apple? And they don't know the market cap of Apple. So my question is, why are you talking to me about Apple? You don't even know what the company is for sale for. So if you're going to invest, at a minimum, you've got to know what the entire business is selling for. And would you be willing to put 50-60% of your total family assets, if you had that much, into that business? And if the answer is no, then don't go there. And I would have been willing to do that at Stewart Enterprises. At the pricing I was looking at and all that. In fact, what I would have done, I would have bought a whole bunch of the debt as well too, just to get total control over the situation. So
very distinct kinds of companies, which should give us clues that these are businesses that we want to hold on to. So the first category of companies that has the potential for these 10 to 100 baggers is these are businesses which have huge tailwinds. Tailwinds means they just have all the factors moving in their favor. They have very deep moats. They have very long runways. They have very high return on equity. They typically don't need any debt. And the most important condition, an idiot can run these companies. So, like Warren Buffett says, invest in businesses that an idiot can run, because one day an idiot will run them. So, which are the companies that a complete moron, stupid idiot can run? Okay, so these are the businesses like See's Candy, Coca-Cola, Moody's, Visa, MasterCard, American Express. These are the types of businesses which are so deep in the moats that it's, in fact, if you look at a company like Coca-Cola, they have more than 100-year history. And in the 100-plus year history, for several decades, the company was poorly managed. And you have a company in China, Maotai. Maybe some of you even consume the product. With due respect, I think Maotai probably has great management, but with due respect to Maotai, an idiot can run that company. Okay, so you do not need anything between your ears. You can put me in charge of Maotai and I can run it. Even a person like me can run that company. That is an unbelievable, fantastic business. Okay, so there's a good friend of mine, you might have heard of him. His name is Guy Spear, and he lives in Zurich, and I think he's going to try to also speak to you next year. Maybe we'll both come together. We'll see if we can do back-to-back lectures. So Guy has a mental model he uses, and his mental model, which he's used actually for more than 15 years, is that if he identifies a company like Moody's or S&P as a great business, or let's say if he identifies Coca-Cola as a great business, or let's say the Coca-Cola bottlers as a great business, what he does then is he looks around the world for Coca-Cola bottlers in other countries. So if he finds that being a Coca-Cola bottler is great in Tennessee in the US, then I want to find the same business in Brazil. I want to find the bottler in China. I want to find the bottler in India. And I want to go around the world looking for the Coke bottler. And I want to find which one is being undervalued. And then I want to invest in it because the economics of these Coke bottlers, no matter where in the world they are, is about the same. They all are great businesses. So one of the businesses, which is the ultimate deep moat business, is Moody's. They do the debt ratings. And even in the financial crisis, when they gave all bad and flawed and garbage debt ratings, it still did not destroy the company. This is a great business that an idiot can run. And so Moody's, Guy said to himself, what are the credit rating agencies all around the world which have the same business model like Moody's? Because Moody's is a model where they'll hire an analyst, they pay him maybe $100,000. For each analyst they pay $100,000, they're probably collecting $4 million in fees. It's just a great business. So just the economics are fantastic. So he found a company in 2001 in India, which was a very small, but was the number one credit rating agency in India, exactly like Moody's was in the US. And he found that S&P 500 owned 10% of that company. So S&P had done a lot of due diligence and they bought a 10% stake in the company. That company was called CRISIL. And so Guy Spear, at that time, he was managing about $40 million. He made a small investment in CRISIL. And it went up, it doubled or tripled in 2-3 years. And then he bought a little bit more. And then another year or two later, he sold it all. He had made like 4 times his money. So sometimes I like to pour salt on the wounds of Guy Spear. Like sometimes I want to have fun with him. I spoke to him last night when I was preparing that talk. I said, hey, Guy, that CRISIL position that you owned, which you sold, if you had not sold, it went up 130 times after he sold. Okay. And he's actually the kind of guy who doesn't even trade that much. He just buys and holds. So I said, hey, by the way, that CRISIL you sold back then, why did you sell it? He said, Mohnish, don't remind me. That's the dumbest thing I did. Because basically, if he had kept CRISIL, he manages 160 million, the CRISIL position would have exceeded the entire portfolio he has today. One decision. And what was so hard about that decision? Well, it wasn't hard. They were a replica of Moody's. I'd already told you an idiot can run Moody's, just like an idiot can run Coca-Cola. And idiots have run it, and they've not been able to destroy these businesses. And so the first thing to do is when you run into businesses that idiots are running or can run, and they still continue to be in business, buy those companies if they have these characteristics, and then forget the P ratio. Just buy and hold forever, because probably those are very, very few businesses on the planet. And like I can almost bet that maybe 10 or 20 years from now, Mautai looks very different. Very different. But it's hard to tell the path it takes, but it looks like a great business. So that's the first one, the businesses that idiots can run. The second is exactly like the first, except these cannot be run by idiots. So these are businesses which are exactly like the first kind, which is they have huge tailwinds, they have deep moats, they have ultra long runways, they have high ROE, they don't need any debt, but they need great management, and they do have great management. So these are businesses like Amazon, Costco, Geico, Amor Pacific, Kotak Mahindra Bank, the one I bought in India, which went up 60 times or something, Blue Dart, which is the FedEx replica I bought in India, Satyam, the IT company, then Restaurant Brands, which is the one that owns Burger King and Tim Hortons, McDonald's, Yum Brands, Domino's Pizza. These are all great businesses, but they do need solid management on top of them to make sure that they keep those franchises. But these businesses have economics that are just phenomenal, just great economics. So that's the second type of business you want to keep and look for in your portfolio. And you get these massive runs, as we saw with Blue Dart and others in India. Then the third kind is the ones which have shown up the most in my portfolio. So I have never had the good fortune of having the first kind of business, which is huge tailwinds and idiots for management. I've never had that. If I ever get that in my portfolio, we're never going to sell those. We're going to keep those forever. Now, the third one is when the market gets confused between risk and uncertainty. And so what I want to do over here is I want to go through some examples from my own portfolio in the past. In some cases, I was able to capture the upside. In other cases, I was too stupid and I missed the upside. I made some money, but I didn't make a lot of money. So the first company I want to talk about, and sorry, these are not businesses you may have heard of, but that's the nature of this game. The ones that are going to be 100 baggers, they're not going to be the biggest names around that you've heard of. So in 2005, I invested in a steel company which was based in Canada. They were traded in the US, called IPSCO. So IPSCO made two types of steel. They made plate steel, and they made tubular steels, kind of like pipelines, drilling oil wells and all that. So they made these kind of the specialized steel, which was either in pipe form or plate form. And the company had the following characteristics when I invested in it. The market cap was $2.5 billion. They had $900 million of extra cash on the balance sheet. And the company had contracts on the book because there were these pipelines that were going to buy their steel for the next couple of years. So they had a 2-year backlog where they knew that their earnings for the next 2 years were going to be $650 million each year. So you had a $2.5 billion market cap, and you had $2.2 billion between cash they already had and then cash that was coming in the next 2 years. And so you would collect about 90% of the market cap in cash in 2 years. And after 2 years, you still had all the plants and equipment and people and all the know-how. Everything was still there. But after 2 years, there was no visibility into earnings. And we know the steel business can go up and down. So the way I looked at it, I said, you know what we're going to do is I'm going to make a bet. I'm going to put 10% of my assets into this. I'm going to just sit there for 2 years. And if it doesn't work, we probably get back 90% if the company is completely gone. But I don't think it's completely gone. I think it's a real business. So what happened is a year later, they made the $650 million. And the year later, they had visibility for 1 more year. And now they said that they would make $650 million for the third year. So now they had 3 years of $650 million, which was almost $2 billion, plus the $900 million. So now we were above my purchase price. So the stock that I bought at 45 a year later
was sitting at $70. So I said, well, we are above what we paid, but we still don't know what the business does after 3 years. Why don't we just wait for another couple of years, see what happens? Okay. So in 2007, I waited one more year. And by now, the stock had gone to maybe $100 or $105. And they got a buyout offer. Another company came and bought them for $160 a share. And when the deal was announced for $157 something, I sold the stock. And so we ended up with almost a 4x in about 2.5 years. Okay. And we captured the entire 4x, right? And so this was a situation where it's a highly, highly cyclical business. And markets hate uncertainty. It's a highly uncertain business. But the risk for this business was very low. So it is what I call very low risk and very high uncertainty. So when you find a combination of low risk and high uncertainty, usually that combination is going to give you a high reward, because markets are not very good at pricing in uncertainty. They hate uncertainty. And so we get some benefit from that. And in fact, there's a business in my portfolio currently, and I don't talk much about my portfolio, but I'll just make an exception because I love you guys so much. I own a company called Fiat Chrysler, which is based in partially in Italy and partially in Detroit. And Fiat Chrysler is very similar to IPSCO. So the stock is at $6 and change. And the management of the company says that in the year 2018, their earnings are going to be around $5. And so if the management is correct about the future prospects of the business, then basically the business is being priced at 1.2 times earnings for 1 year. And so my answer to that is, okay, we'll hold the stock till 2018. If it's completely worthless as a business, I mean, they have 130 billion in sales of cars. They just started manufacturing Jeep in China. The Chinese love their Jeeps. Raise your hand if you think Chinese love Jeeps. All right. At least a few Chinese love their Jeeps. That's great. So their Jeep sales are going up like 5 times in the next 3 years in China. But anyway, so I happen to think that what they are saying makes sense. The market thinks it doesn't make sense. So no problem. Just like IPSCO, we put the stock in the portfolio and forget about it. And I'll wake up in January 2019 and see what happened. And if you invite me back in 2019, I'll tell you what happened to Fiat. And between us girls, we may end up with 5 times our money if it trades at 5 times earnings, or 7 times our money if it trades at 7 times earnings, and such. So that's it.
You are definitely better off buying a growing company over a cheap, no-growth company.
Okay.
So if I buy an asset that is cheap, that has very limited growth, all I'm going to do is cover the gap between it may be worth 100 rupees a share, I'm getting it for 50, 60 rupees a share. I'm just going to make the 40 or 50 rupees over whatever period of time it takes to get there. Now, if I'm buying a company that has secular tailwinds, great management, and long growth engines, as long as I'm not paying up too much, it's the best place to be. Whatever the markets are doing, they go high or they go low, if tomorrow a deal shows up for a particular business to be bought, what's happening in the markets would have very little impact on what Berkshire Hathaway would do. And so that is, I think, a great way even for investors to think about things. So in the long run, if you're right on the business and the prospects of the business, that is what is going to drive your returns versus what is happening with markets and economy and those sorts of things.